Our third session is one of the special session for us because it's all ladies session. As we begin with our third session, we extend our heartfelt thanks to our sponsors who made this event possible, beginning with a shout out to our silver sponsor, Central Bank of India, Ugro Capital, associate sponsor, Punjab National Bank, SIDB, Fintech Partners, Plutus One and Scormi Solutions Private Limited, Knowledge Partner, Resurgent India, corporate contributor, Manappuram Finance Limited, SAIS and Omni, FlexPlay, association partner, PSLAI and FIDC, and our exhibit partner, Canara Bank. Our third session is on balancing growth and compliance for NBFCs. This session will address the tightrope walk that NBFCs navigate to balance growth with regulatory compliances. Please join me by giving a big round of applause and welcoming our panel of esteemed speakers for the session. I would like to begin with the moderator of the session, Mr. Vinod Kothari, Director, Vinod Kothari Consultants. Big round of applause, everyone. It is an honor, sir, for me to introduce you, and who is an internationally renowned author, trainer, and consultant on financial subjects such as housing finance, securitization, credit derivatives, structured finance, and banking regulations. Known for his expertise, Mr. Kothari has lectured globally from New York to London to Singapore, Sydney, Johannesburg, engaging diverse audiences, including rating agencies, investors, tax officers, legal professionals, and executives of major financial institutions. A fellow of ICSI, Mr. Kothari has led Vinod Kothari and Company in corporate law practice for over 30 years. We welcome you, sir. Our first speaker of this panel is Ms. Bonani Roychoudhury, MD, NABSAMRUDDHI Finance Limited. Ms. Roychoudhury, with an MBA in Finance, an MA in Economics, and certifications from IIBF, has dedicated over 3 decades to NABARD. Her expertise spans institutional finance, focusing on green finance, WASH, infrastructure, microfinance, and financial inclusion. She has significantly contributed to advancing rural financial institutions in India. We welcome you, ma'am. Our next speaker is Ms. Geeta Chainani, Associate Director, Care Ratings Limited. Ms. Chainani possesses over 12 years of expertise in credit analysis within the BFSI sector, where she oversees ratings for diverse financial entities, including housing finance companies and NBFCs. She is actively involved in industry outreach, contributing insights through webinars, publications, and engagements with investors to provide informed rating perspectives. A big round of applause, everyone. We all are energetic now. It's session 3, post-lunch. Now, our next speaker is Ms. Shilpa Mankar Ahluwalia, partner Shardul Amarchand Maangaldas. Ms. Ahluwalia brings over 12 years of expertise in banking, finance, and corporate law. She advises major fintech companies and investors, including Facebook, WhatsApp, PayPal, and Amazon, on regulatory and product strategies. Welcoming our next speaker, Ms. Smita, partner Khaitan & Co. Ms. Smita is an advisor on banking, finance, insolvency, and digital lending laws. Recognized as a recommended lawyer by the Legal 500, she actively contributes to industry consultations on fintechs and restructuring issues. Now, I would like to hand over the mic to our moderator, Mr. Kothari.
Thanks, ma'am. Thank you very much. The caption of the session is balancing between growth and compliances. As this is the afternoon session, the biggest challenge is balancing between networking and the discussions. And quite often, it's the first part which takes over, therefore people are still to usher in. But if the volunteers can help, yeah, I think best is to close the doors so people who would like to be inside can come inside. This session, as the MC already indicated, is unique in the sense there are 4 ladies that I need to be moderating. At home, just one keeps me subdued and moderated all the time. Here I have 4, and I think in interest of my safety, they kept me a little away from the 4. Light away in apart. Let's maybe straight get started with a very serious discussion today. And I'm going to make a next serious statement. Tell me if you find it serious enough. That the compliance environment for non-banking finance companies is all cool and comfortable. Did you find this serious? Is it seriously amusing? So things have obviously taken a sharp change. This change might have been slow for people who have been like insiders. Probably the change is slow and let's say predictable. But for a lot of others, the change was very sharp, very fast, almost unpredictable. Some people even say unprecedented. But there have been actions by the supervisor against specific practices. I wouldn't even talk about against specific entities. After all, when regulatory action is taken, it's taken in light of certain practices. But then it does hurt certain entities. It hurts some specific entities more than others. But in general, the view around is that actions of the supervisor have hurt almost every player in the industry. Non-banking finance companies in general today, the feel is one of introspection. The feel is one of regulatory risk assessment. I think the key word today for most of the NBFCs, large or small, is that the biggest risk that the sector faces today is regulatory risk. And this regulatory risk has come to the fore over a period of time because NBFCs have been doing quite well. I think post ILFS, post COVID, once the impact of COVID was over, NBFCs in general were doing quite well. I mean, the growth rate was fantastic. It was regularly, consistently exceeding the rate of growth of banking. And of course, the NPA levels were also by and large manageable. The rates of interest were quite good. Thanks to digital lending, they were able to maintain fantastic growth in asset size as well. And in order to maintain a bridge between the banks and the non-banking finance companies, long time back they had a window called securitization, which was found to be tough. Then people moved to so-called direct assignment, which also became tough in 2021 as the RBI came with fresh regulations on direct assignments. And then co-lending came on the scene. So co-lending came as a sort of what one would look as an easy alternative to effectively do what co-lending was achieving, at the same time with less of regulations. And then 5 years back, because Ashish ji would just be celebrating 5 years anniversary of the co-lending circular of November 5, 2019 or 2020, 4 years, 4th anniversary. And that made a sea change because the newfound way of so-called CLM2, which is basically the so-called discretionary co-lending, that you pick and choose, you can cherry pick assets and still call it co-lending. And in certain respects, this might still be exempt from the minimum holding period requirement. So you can actually do an on-tap direct assignment, constantly keep originating assets, keep pushing assets to your co-lenders. You could probably expect a lower cost of funding from the co-lenders. And therefore, on your share, 20 or whatever else it is, the rate of return could be significantly higher. This party was going so very decently, so very well. When I'm saying this party was going, I'm not saying that's end of the party still, but yes, there is a sort of an introspection now needed, because from the press reports and at least the anecdotal hearings, it seems that the Ministry of Finance also wants the growth in personal lending, particularly unsecured personal lending, or even microfinance. There are some bit of reforms of regulatory practices that the regulators are expecting now. So probably bankers will now be in a mood of, well, let's check what we're doing. Let's check our co-lending partners. Let's check the regulatory health of co-lending partners. Because if you are a partner with another entity which undergoes a severe regulatory review, I must say, in a sense, there is a reflection back on you as well, because you are partnering with the NBFCs. So that's the topic for discussion today. I have a wonderful panel consisting of and people who are into lending, people who are legal experts, and a person who is a rating analyst as well. So I've got basically a mix of participants from the lending space, from legal space, as also from rating analyst point of view. So we would be able to examine the compliance environment from different angles. Let me straight get started, and let me first ask Bonani to give a very short 1 minute perspective just to break the ice with the audience and give your very short reflection on how do you see the compliance scene now in the non-banking space after the recent regulatory actions, Bonani.
Okay, thanks Vinod, and thanks AIFAI as well as Resurgent India for having me here. Absolutely an honor. And a very relevant question, because we have seen a spate of regulations happening over the last 6 months, I would say, in different segments. And it has affected us as well. Very honestly, we are wholesale lenders. For those unacquainted, we are a subsidiary of NABARD into B2B lending. So, and we had a ESG focus as well. So we were very cautious about who we work with, who are the partners. And most of our clients had onboarded into co-lending, either as an upstream or a downstream role. And we have seen that last year the story was different. Last year by this time, and even I would say first quarter, second quarter, the business was huge. So if we look at the volumes, we can see that there is a contraction in volumes. Whether it's defined by underlying business or underlying end borrowers, whether it's the demand at that level, that is the question. And what we actually garnered from our clients is that they don't have issues with their liability as much as they have issues with their asset side today. So they are unable to deploy. Is it only because of regulatory action, or is it also because something's changing at the end borrower level, whether it's the rural or semi-urban, whether actually there is a contraction in demand for credit, and that would that can translate to whether there is a contraction overall demand. So again, I leave it to the discussions.
Geeta, let me just, the same question moved to just short 1 minute reflection on what's happening in terms of compliance environment in the NBFC sector.
Sure. So, co-lending had been growing very well. FY24, in fact, the discussions that we were having with various financial entities, in terms of tie-up and volumes, they were seeing 3 to 4 times increase in co-lending volumes. But what has changed in the last few months? So is it just the volumes, or is it the business also? So also looking at the fact that there have been various regulatory actions. Now, what will be the fallout of these actions? So basically, it will prompt the senior lender, which is the bankers, to do more due diligence of their co-lending partner, whether that partner is in line or not. And also, if we all go through the regulations, it is mentioned that the credit sanction process as well as the due diligence, the responsibility of that falls on both the junior as well as the senior partner. So that is something that bankers will have to take care of. And last but not the least, due diligence will get its, a lot of precedence. Because if we step back and we look at where are these, which are the areas in which these regulations are coming in. So basically this is with regards to, stopping of onboarding of customers, be it credit cards, be it lending products, or the regulator having certain concerns from a supervisory standpoint, compliance standpoint. And these are important areas because co-lending right now is at a nascent stage, right? Just a back of the envelope calculation, if I were to do, because there is no credible number for this, it would be slightly over 1 lakh crore of AUM. But right now this market is growing, right? So it seems, probably it seems a right time for the regulator to intervene so that the risk doesn't spread.
Yeah, right. I think that's a very important point. I mean, Geeta has made extremely important points. And number one, she said that when a banker signs a co-lending agreement with a non-banking finance company, given the fact that the due diligence and the responsibility for practices is on the senior lender as well. And therefore, you cannot be comforting yourself saying that I am not doing anything, it's the NBFC which is handling and therefore it's their business. No, that's not acceptable. That's one very important point she made. And she also made another very important point that we are currently at 1 lakh crore, but the scale at which we are growing, this may be the right time for the regulators to interfere and maybe set the ground rules before things become out of proportion. And let's maybe park it for a minute. We come back to you, Geeta, on that. But let me move to Shilpa. Your initial thoughts on how do you see the current scenario?
So I think very relevant questions given what's happening in the market. But I think, very quickly, my short take on co-lending is, yes, I think definitely regulatory risk has increased. It's become a focus area for the regulator, but I don't think the business model is really going to go away. It's worked so well. I mean, for two key reasons, all of us in the room, know the strengths of the co-lending model. One is each party brings its strengths to the table. The banks bring their lower cost of capital, and the NBFCs bring their ability to leverage tech to access consumers, their wider credit reach. And it's worked particularly well also in opening up certain credit access channels for lenders, for borrowers who may not otherwise have access to finance. The SMEs, the MSMEs is something we were talking about earlier, the small businesses. I think the co-lending model has really worked for these segments, where NBFCs are using different tools to do credit underwriting, using data, using big data, using alternative models to assess the credit risk of consumers. And that has opened up credit access. So from, at least from that perspective, the demand side, that will continue to grow. But I think the regulatory risk the RBI has, regulators have pointed out, are broadly in 2 or 3 dimensions. Systemic risk concerns around growth of unsecured lending, growth of consumer loans, personal loans. And I think this is a time where both the regulator and I think platforms and banks will really focus on compliance, regulation. I think the amount of time and resources that platforms spend on compliance will increase. This will be a demand from investors as well. And in terms of, I think, banks focusing more on the business models, the kind of KYC, I think what Geeta had mentioned, the kind of credit underwriting models, I think the approach where it's not my problem, it's the NBFC's problem, I think that approach is definitely going to change, because there'll be an expectation that the regulator is clearly set out, even in areas where you may not have a defined set of rules, for example, pricing, right? I think there again, banks will start thinking about what the pricing of the end product looks like for the consumer, because ultimately, these are areas that the RBI has indicated are concern areas for the market.
Vidushi, moving over to you.
Thank you for the question, and I think panel members have already touched upon most of the points, but I will tell you, being a corporate lawyer, looking at what regulatory actions the regulator has been taking, right now there's so much skepticism and cautious behavior from everyone, and specifically for co-lending, because if you look at it, it's just one key circular. Now, whether one key circular can, tell us all the points, how to ensure compliance, it is practically impossible. So at this point of time, it becomes very important for all of us to analyze how regulator has been behaving, how we can ensure that we are on the right side of law, and what calls we take reading the circular. I think that becomes very important, especially at this point of time.
Absolutely well said, Vidushi. When you talk about the supervisory action against some of the lenders in the recent past, the RBI talked about certain practices. Press releases are never so very detailed in terms of what were the practices, but primarily the feel one gets is in respect of the following practices. A, the rates of interest. That's something that the RBI has time and again been talking about, that we liberated the rates of lending. Earlier there was a cap on the net interest margin in case of microfinance, which was done away with. There was no absolute ceiling on rates of interest ever for non-banking finance companies. So we've been extremely liberal in permitting you to charge what you feel like charging. But that doesn't mean people can take liberty with borrowers and start charging what the RBI says is exorbitant or excessive rates of interest. So rate of interest was one point. Nowhere does the regulator ever say what is the rate of interest beyond which I will have a problem. But nevertheless, we are told rate of interest is one of the issues. Second issue, of course, was transparency in disclosures. This has been, once again, one of the so-called fair lending practices point of view regulatory issue. But I think of late, slowly, the RBI has made a so-called KFS disclosure mandatory for most forms of lending. And KFS now mandatorily says you need to compute a certain annualized percentage rate which has to capture several elements. So that transparency in lending disclosure is mostly taken care of by practices which are implemented over time. The third thing which regulator quite often talks about is evergreening. And this is a consistent problem with the industry, that quite often people give loans. They may be called top-up loans. They might be given the name of a personal loan to the same borrower who has a running loan with the lender already. And the proceeds of the second loan are used to take care of the delinquencies in the first one. Therefore, the second loan is basically a device to evergreen the first one. And therefore, so it goes. So there's a third loan which is taking care of the second loan and so on. So evergreening, note that banks have been doing it over the years. Governor Rajan talked about it as zombie banking. And different other commentators in the past have been talking about use of ARCs or use of AIFs for evergreening loans with banks. But that's been going on with the banking sector. When it comes to NBFC, that's been one of the regulatory objections. And the next objection which RBI has actually flagged in terms of their observation particularly for gold lending, which quite often takes the shape of agri loan also, that you are calling it agri loan, but you're not monitoring the end use of the money. Because what is gold loan? What is agri loan basically is the usage of the money for farming purposes, not the fact that you are a farmer. Everyone could be a farmer in some sense. I might be having a papaya tree in my house. I might be growing a couple of tomatoes in my kitchen. So I might be a farmer everyone might be a farmer in that sense. But the meaning of agri loan is not whether you have a tomato growing at the back of your house, but whether the proceeds of the loan are used for farming purposes. And that is quite often evident looking at the magnitude of the loan itself. So that these were primarily the objections of the regulator. And I'm coming to the first one, which is the rate of interest. And Bonani, I'll direct this question to you. Rates of interest the RBI has been talking about. The RBI has never spelled as to what is an excessive or exorbitant rate of interest. What feel do you have in this? When do you say we are crossing the Lakshman Rekha from, is there a Lakshman Rekha at all? Or Lakshman's Rekha was invisible, so there's some kind of invisible Lakshman Rekha?
Yeah. Yes. So again, very relevant question, something that we get asked a lot. As far as RBI is concerned, for MFI sector, there was a Lakshman Rekha earlier, right? Then RBI went into deregulation, and that was, mind you, only for the NBFC MFIs. It was not for others, so there was no level playing ground there. So when they removed it, it was expected that the NBFCs or the MFIs would be charging rates which are in sync with their cost of funds, let's say, because that's what it was tagged to. It was tagged to a benchmark earlier. But again, we know that there was different entities in the MFI space. I'm mentioning MFI because this is where it's hit the most. And we have seen that MFIs who have ROA of even 6 and 7%. That's where the regulator is concerned, that I don't care if you charge 30% if your cost of funds is, let's say, 16 or 17, because in these segments where it's microfinance or unsecured business loans, where you are really working in the remote rural areas, OPEX is going to be very, very high. So taking into account the OPEX, your risk cost, because this is a very high risk sector again, very high risk segment. So taking into account after all that, if you have a ROA of 6 and 7, when others have 2.34, even maybe 4.5, that's, we see around 3 is the general one for the clients we work with. So then that kind of a ROA doesn't justify, and that's where this is what we come to know from the inspection RBI conducts of the MFIs, where they ask questions on why is the ROA so high? Is your rate really justified? And there's no reason for different MFIs to have the same rates. We almost find similar rates. There's no reason. For any banker, the COF is very low. Then we come to NBFCs at different levels. So we look at a MFI working in a remote area which takes funds from us, let's say at 14%. So obviously their ROI is going to be very high. So ultimately, it is the rate at which, it's your earnings. You have to look at the returns. So a very high return is not justified because ultimately it will not sustain. The rural areas or the semi-urban areas, they are not earning this kind of return. So they can't ultimately sustain, so evergreening is bound to happen. Otherwise, you won't get your loan back and they won't survive. So that's why it was a kind of a reminder, it was a wake-up call, and I think most of the MFIs are waking up. SROs have woken up and have even given kind of guidelines to the MFIs that please look into your ROA and stop evergreening. Things are going to fall in place. I hope that answers the question.
Absolutely fantastic answer, Bonani, and I'm hoping that the audience is getting all included because she's making extremely pertinent observations. She talked about ROA. Remember, she didn't talk about ROI. She was talking about ROA of 5 to 6% return on assets. And the way the competition goes, if the cost of borrowing of MFI is, let's say, about 11%, cost of overheads, I would assess, would be between 5 to 7%. If it's efficiently managed, probably 5. Smaller entities would probably be 7, so that 11 plus 7 makes it 18. Cost of risk, which is also computed these days. Most of the NBFCs, MFIs will be following Ind AS, and therefore they are computing cost of risk in form of what is called expected credit losses. So that would add up to another 3%. So 11 plus 7 plus 3, that makes it 21. If I'm lending at 24%, my ROA should actually be 3. If the P&L is reflecting an ROA of 6 or 7, that would mean there are sources of earnings other than ROI, rate of interest. And that's very important. These days, most of the lenders have found other ways of earnings besides earning out of interest. They'll probably be selling some alliances with some OEMs. They might have probably alliances with some insurance companies. Unfortunately, insurance companies also become a part of the game. There's substantial pass back of commission from the insurance companies that gives a decent earnings to all forms of lenders. MFI is just in one example, but all forms of lenders make a significant earning from insurance companies. So all in all, if you're talking about 6% ROA, that's actually significant. She's right in saying that at an income level of 25,000 a month for the family. Remember, the definition of MFI is 25,000 per month at household level, which means husband and wife both are working. Their aggregate income should not be exceeding 25,000. So 25,000 income the person who makes will still be spending 12,000 rupees on meeting his, bare basic domestic needs. Khana khayega, kapda pehnega, medicine lega, that will take 12,000 rupees for barest minimum necessity. You are left with just about 12,000 rupees. With the 12,000 rupees to service a loan carrying 24% rate of interest, there is obviously a question of affordability. I am not sure how this is explained as affordable, but that's a very key question that Bonani has raised. Let me now Bonani, and I think probably even, let me ask this question to Geeta as well. Cost of lending is a very important issue she raised. When it comes to co-lending, I have a co-lending partner who has indicated his cost of funds. I have a bank which is saying, I will charge you 12% rate of interest. So cost of lending is fixed when it comes to the bank. My own cost of capital, maybe for example, let's say it's 30%. Therefore, the blended cost of lending, given the fact the banker is charging only 12, my own cost is 30, could still be the weighted average because the banker is providing 80% of the money. So if we compute a weighted average, the cost of lending ought to be still cheaper than lending entirely on the balance sheet, which means the whole purpose of the RBI permitting co-lending, which you can see very clearly in the 5th November circular, is that we are doing this to allow lower cost of funding to the borrowers. in co-lending, do we actually see the lower cost of funding? Bonani, this question briefly to you, and then we move to
Absolutely,
Geeta.
yeah. In so many cases, we have seen that this is being passed on in the sense that there is a blended finance and it goes to the cream de la cream of the clients, obviously, because somebody has repaid 2 cycles of loan on time, they deserve, and it also becomes a kind of example to the others that I need to be a good borrower, I need to follow credit discipline. So we have seen this with especially the public sector banks where they have had a deal with the originator. So where the originator's rate was 26%, we have seen a 19% blended rate, that is 9 plus 27 for the entire loan. I know that there is a huge differential on the 20%, it's true. But again, the OPEX and everything is high. So when you look at the weighted average, it's not a huge benefit. What really serves as a benefit here is that the best of the borrowers are getting a lower rate. But this has not happened in all the deals. Definitely, even where it was bankers coming in, it should have happened. It has not happened in all the deals, and that's surprising. Whereas when it comes to NBFC to NBFC co-lending, which is not covered by the circular, and I'm surprised that nobody thought of it earlier. It only happened after RBI came out with the circular on co-lending. Earlier we were co-financing projects and all. But retail level, the idea came only after the circular happened and everyone is misusing the CLM2. CLM2 is only for banks and NBFCs for co-lending, for priority sector lending. It was meant for that segment. But lot of deals we are seeing where it is NBFC to NBFC, no change in the rate of interest. It's just the win-win situation for both. Huge margin on that 20%, and they are also taking the MHP advantage, which they should not be. Just wanted to point it out.
Once again, she made an extremely important observation. I hope the audience heard. Afternoon time, I'm hoping you're still able to maintain yourself agile. Huh? NBFC का रात का नींद उड़ गया, afternoon में सोने का कहाँ गुंजाइश है? She made a point that the so-called CLM2 was only for PSL lending, that too between banks and NBFCs. That use of CLM2 or the MHP carve-out for non-PSL lending and still calling it CLM2 is not actually not envisaged by the regulator. Geeta, same point coming to you with cost of lending. Is it actually being passed on to the borrowers because the co-lending weighted average cost is anyway cheaper?
So, if you look at both the structures, CLM1 and CLM2, I think CLM1 is more favorable in terms of passing on the cost structures. But unfortunately, most of the deals that happen, they happen on CLM2 because of various operational issues, and tech has to be integrated right from the start in CLM1. So with maximum deals happening on CLM2, I would say this is hardly getting passed on. So let's say for the NBFC, probably they would be able to get some kind of a lower cost of funds. So for example, if a BBB NBFC would be raising capital at say 12 or 13, and with bank is the hurdle rate is 10%. So probably they are able to get the lower cost of funds if they enter into co-lending for that proportion of the portfolio, but not necessarily getting passed on to the end user.
I just have a follow-up question to you, Geeta. The question is about you as a rating analyst looks at the business model of an NBFC which is focusing on co-lending versus another NBFC which is on balance sheet lending. In the former case, do you see any differential risk factors given the fact that the assets which show on the balance sheet are only my share of the loan, just about 20%? Whereas the exposure and the returns both could be on much larger portion, which is 5x because I've got 80% share, which is not on the balance sheet at all. So my balance sheet is already leveraged 5 times because of the off-balance sheet 80% assets. On top of that, I have leverage on my own balance sheet as well. My balance sheet itself is leveraged. If my balance sheet is a 5x leverage and I have a 5x leverage off the balance sheet, I'm talking about a 25x leverage. As opposed to that, think of an entity which is lending on the balance sheet itself. As a rating analyst, how do you differentiate those two scenarios?
So firstly, we will look at the business model, the usual things, assessment in terms of how is the loan getting originated, underwriting is being done, and the loan is being collected. That is obviously something that is being looked at. you made a pertinent point on the leverage. So, because obviously the NBFC, so here what we look at is that what is the proportion of co-lending that NBFC is doing? Because that is the headway they are getting in terms of leverage. So the more co-lending I do, the lower would be the leverage, and obviously my earnings also wouldn't be really an apple-to-apple comparison with the other NBFCs. So since you touched upon the leverage, it is not just leverage, it is in fact the entire business and the earnings and the return matrix. So when we look at leverage, we look at AUM to net worth. So that is how I am factoring for both off-book and on-book growth that is happening, and I'm looking at it from a net worth perspective. Interestingly, another important point here is that for some NBFCs, co-lending is a natural business choice that they are doing. It is that some portion of their business would be co-lending. For some NBFCs, we have seen that there might be issues with regards to raising of funds, due to which the natural choice of business would be co-lending. So here we also look at whether that particular NBFC is able to raise money from the market or no. So suppose if I give you an example of a MSME or a housing finance company, typically my loan should be 4 or 5 years if you are an MSME, 7 to 8 years behavioral maturity if you would be a housing finance company. Now, I should be having more term loans on my liability profile, but I might be having more working capital loans, because if 50-60% of my incremental business is getting co-lent, and that is happening within next 1 month, I'm transferring the loan through CLM2, then I don't need term loan, I need working capital. So here the liabilities entire profile would be different for that particular NBFC. So we look at that also, whether that NBFC is able to, are they able to raise funds from the market or no. Plus there are other things when we talk about earnings. So one is that I would be getting fee income. I would be having net gain from sale of financial assets, which kind of would be showing that my ROTA return matrix is higher than the peers. That may not be so. So we kind of look at all these return matrix from a AUM perspective, so that we are doing an apple-to-apple comparison.
Very pertinent point once again, because you're also saying that in case of co-lending, it helps to mitigate the risk of asset liability mismatches, because the profile of assets and the profile of the co-lending, co-funding that are raised exactly matches, except for the 1 month period during which I'm warehousing assets to be passed on to the co-lender in terms of CLM2. Very, very pertinent once again. Shilpa, I'll move to you and I'll ask you, when it comes to co-lending, other than the November 2020 circular, which as Bonani mentions was drawn for PSL transactions between banks and NBFCs, there is absolutely no ground rule raised or laid by the RBI for co-lending. And absence of rules may give us two possible scenarios. A, that there is no rule, therefore we write our own rule. Whatever I write is the rule, that's one. Or may mean that the size of the cake is becoming large enough, and therefore there might be a situation when things become completely unmanageable, and therefore we ought to have a discipline, bare basic discipline from the regulator. So is this, do you think this is the time for having a book of rules for co-lending, or do you think we have sufficient regulations anyways? What would be your take?
Okay. So Vinod, actually I'm going to draw from two very important points that you just made earlier, which feeds into this discussion. Is one, you spoke of interest rate caps. There are no interest rate caps for co-lending models, right? But still we see it is a concern that the regulator has expressed and has taken action where they feel these interest rates are exceeding what should be, what should be the norm. Second is there is no regulatory framework for non-PSL co-lending, and a lot of the co-lending models we're seeing today are actually non-PSL. So, platforms come to us and say, how do we develop a business model when there is this regulatory void, but clearly there is a regulatory expectation. So how do we know where to draw that Lakshman Rekha which you spoke of, right? Because there is no clarity on what the regulatory framework is. I think the way to think about this is twofold. One, a lot of financial product growth has actually happened in a regulatory black hole. Because if you look at, even if you look back, a lot of the fintech regulation, for example, what happens is you have product innovation, which takes place without laws in a regulatory black hole. Once you achieve a certain critical size or mass, then regulators feel this, this product has generated a sufficient scale and risk that we need to step in. And then the regulations come in. But I think even in a regulatory black hole, there are enough cues you can take from existing laws for similar frameworks. And also you can take cues from the way the regulator has been reacting to various products, business models, processes. I think if we look at, if we look back, I think there are 3 or 4 focus areas that I think everyone in this room will agree has been a concern for the regulator. One, systemic risk. What does your business model mean for systemic risk? What are the KYC processes? What are the end use requirements like you mentioned? Are you really complying with the spirit of the law, not just the letter of the law? In the digital lending sector, we saw how the RBI came up with a set of rules on FLDGs, default guarantees, because they clearly felt that that was an area where there are no rules, but it created a lot of systemic risk by moving credit from a licensed balance sheet to a non-licensed balance sheet. So you have a sense of what are the things the regulator really cares about, and I think you can always test your product against these 3 or 4 things. So one is systemic risk. The second is the consumer. What does this mean for the consumer? Is the borrower being compromised in any way at all? And then again, we come to what you spoke of, transparency, disclosure of costs. Are there any hidden costs in the product? Are we disclosing the APR? And a lot of the regulation, again, has been triggered by making sure the consumer, one, is fully aware of the terms and conditions of the product, of the pricing, and the recovery processes are in line with, with what they should be for banks and NBFCs. So second is the consumer is really the focus or a lot of the regulation. Recently, again, the RBI came up with loan aggregator rules, which said that even if you are a loan aggregator platform and you believe there is a certain product that is best suited to the consumer, you still need to make full disclosure to the borrower at the back end, what is happening at the back end. So that's number 2, I think. The third really is data. I think as we transact more and more digitally, we all generate much more digital data, which has a lot of uses. I mean, I think lenders can use a lot of this data to customize loan products, credit products, and understand the consumer. But I think there's also a lot of scope for unauthorized use. And this has really been a big focus area of the RBI. And I like to call it the 3 W's of data protection, right? Oh. Does the borrower know what data is being collected? Does the borrower know why is that data being collected? What is the purpose? And third, where is it being stored and who is storing it? So I think as a lender, if you are collecting data and accessing data, you need to make sure that you have a consent architecture in place, that your product actually, you do enough to protect consumer data, and you partner with NBFCs. For banks, they need to partner with NBFCs that have sufficient data security tools in place. And for NBFCs, they need to make sure if they are partnering with other tech platforms, data is a real big focus area. So I think while you're absolutely right, there is no regulation, but I think there are enough cues in the system that we can draw from or that platforms can draw from to come up with business models that are not pushing the boundary and
Fantastic.
Are compliant.
Normally when lawyers speak in public platforms, they keep things vague. It helps them. This time I've seen a lawyer speaking with absolute clarity that while there are no ground rules, but there are enough cues and clues you can draw from parallel regulations and set for yourself a set of rules that you would like to abide by. Before I come to Vidushi on a very sensitive question, I'll open up what the question would be, but let me ask audience, are you all wanting to interact with the panelists here? Are there people who are going to ask questions? One hand, that's one, just one? Any other question? Because I'm trying to time that. since we need some kind of a hard break here, so I'm just trying to, no, please don't pass on mic just now. I'm just trying to assess how many audience questions would there be. I've got one. Anyone else? No. Okay. So I'm now asking the question to Vidushi about a little sensitive question on applicability of GST. Now the context of the question would be that there is a rate of interest that lenders expect, the funding lenders. They expect 12, 13, 14%, whatever. And the NBFC is charging good 26%, therefore that leaves a spread of 12%. Is this 12% in nature of service fees? If the answer is yes, then the service fees are chargeable to service tax. Is this 12% in the nature of interest on your 20% share? In case of interest, there is no question of service tax, but then the GST authorities would like to take a view that after all, the originating lending partner is providing services to the entire partnership and it's getting compensated for those services, and therefore there is a service tax element inherent. Vidushi, what's your take on this? Is an unresolved question though, but what's your take?
Like you said, very, very sensitive topic. टैक्स में जैसे मीन्स इट्स नॉट अ क्वेश्चन बट एक भी पैसा ज़्यादा देना पड़े तो बहुत चुभता है इंडिविजुअल बोलो या कॉर्पोरेट बोलो एंड व्हेन वी आर टॉकिंग अबाउट को लेंडिंग सी को लेंडिंग द फ्रेज इटसेल्फ मीन्स वी आर लेंडिंग टुगेदर we are partners. Bank, NBFC, both are partners. We enter into an arrangement where if I am an NBFC, I am taking the responsibility to say recover the loan, okay, or some other some other roles I am playing. It's not a service, and the extra interest which I am charging is charging because I am taking a lower priority. So where is the service coming from? It is actually interest. Vinod, you were saying that there are various other avenues of generating income, but this is not one of the avenues. This is pure interest. So there's no point of charging, calling it a service. It's one of the roles or responsibilities that NBFC is taking as a partner in co-lending. But whatever said and done, I know lots of NBFCs have made representations, associations like FIDC have made representations, but until now there is no positive response that the industry has got from the tax authorities. I can share, and we were also discussing before this session that what is a workaround. Workaround is that, NBFCs are trying to just call out particular amount, reasonable amount, say 1 lakh is actually a service fee because tax authorities are not cooperating, if I may say that, So we'll just say that, okay, 1 lakh is the service fee, you charge GST on this. Because it is not GST, but how to work around when the authorities are not cooperating, they are not looking at it the right way. So it is absolutely a sensitive topic.
When taxpayer and tax collector, there is a question of cooperation. घोड़ा और घास के बीच में दोस्ती कहाँ से हो सकती है? Right. You are right, unresolved question, but quite significant because one would probably call it interest if the share of the originating co-lender was subordinated. But like most arrangements have, the share is, at least theoretically, the share is pari passu. And therefore, on a pari passu share, I still get 40, whereas the other co-lender is getting only but 12 or 13. I think this is a question of how do you document, how do you establish the entirety of transaction. So before I open up to the audience, I have one quick observation. Once again, I think the point we all need to understand, and I think all the panelists have said this very clearly, that while there is no set of rules for non-PSL co-lending, most of the co-lending which is happening is either non-PSL or is happening between banks and NBFC, and therefore there may not be clear set of rules. But absence of rule doesn't mean there is absolutely no ground rule at all. Like the lawyers on the panel did mention, that you need to understand from the spirit of the regulation. And these days, RBI is not going simply by letters of law. Time and again, you would have heard them saying, comply with the regulation in letter and spirit. Quite often, the letter may not exist. But comply it in spirit. Understand the spirit from wherever you can get it, but comply it in spirit. I'm not looking at those spirits which probably might, invigorate your evenings, but they would like the spirit to be followed of the regulation. So that's the essence of all regulations. I think co-lending has had a tremendously good time. I'm hoping co-lending will continue to have very good time because it's something which is partnering of differential strengths. There are entities which are good at funding. There are entities which are good in disbursement. There are entities which are good in servicing or managing. There are entities which are good in digital lending. So if people have differential abilities, they ought to come together. That's the beauty of the system. People should capitalize their own differential strengths. Economically, there's absolutely no argument against co-lending. I completely say that there cannot be an economic argument against co-lending. The only question is where there is a risk, there must be capital. And therefore, if the risk is being taken by one of the partners should accordingly have allocated capital against the risk as well. Let's open up for audience questions for at the most maybe 5 minutes if we have questions. There was somebody, sir, you want to ask him? Anyone else who is wanting to ask question, please keep your question ready because we'll probably have a hard stop in next about 5 minutes. Yeah. So is the mic working? Right. So maybe can I give a brief answer? With the permission of all, can I just give a brief answer to that? Because typically when you do a loan agreement or sanction letter, you say that we intend CLM to the co-lender comes subsequent to origination. So always that's why it's called discretionary co-lending. So we do say in the sanction letter that we will try to bring ABC co-lenders, and once we bring the co-lender on board, we will intimate to you the name of the co-lender. So that's consent to bring an unnamed co-lender is taken from the borrower. Subsequently, the name is indicated to the borrower. The borrower's consent is therefore deemed implicit in the terms of sanction itself. That's the only way in CLM2 you can actually take borrower's consent. Any other question from the? It's money. That's right. Yes. Subsequent, once you find a co-lender, then you give an intimation to the borrower that as per clause number whatever of loan agreement, we have brought, let's say, NABSAMRUDDHI as our co-lending partner.
Yeah, and if I may just add, like he was saying, it's a prior consent. You are already taking that consent that I may transfer it, or CLM2 model I may imply, and I'm taking your consent straight away. Sure. So it's a prior consent, and consent has to be really very stringently looked at, especially with the data protection new laws also coming in. Regulators looking at it very stringently. So we should all make sure that consent framework is well put in the documents.
You are right.
That's right.
But what regulators expect that, especially a particular co-lender. So, sir, in case of I'm saying subsequent communication is very important, right? But prior sanction in CLM2 is impossible. CLM2 is always discretionary, which means the co-lender decides to take a loan only subsequent to origination. At the time of origination, the co-lender is not even there on scene. So, because it's discretionary, therefore the name is communicated, but anonymous sanction without the name of the co-lender is taken at inception, as Vidushi points out. Any other question from the audience at all? At the back, there's a hand going up. Yes, please.
Hello all. I have actually a couple of questions. One is with respect to CLM2. People say CLM2 is akin to DA. So is there a requirement of getting a legal opinion every time we can do a DA with the CLM2
I'm sure
partner?
there are interested parties here, they'll say yes.
So,
do you want a disinterested answer or interested answer?
I want a disinterested answer. Also, can we do a master DOA where we are doing...
That's the answer, ना? आपके पास आंसर था, कंफर्मेशन जा रहे थे क्या यहाँ पे?
नहीं, मेरा एक दूसरा क्वेश्चन है कि अगर मैं मास्टर DOA कर लेता हूँ and on an ongoing basis, I am doing, on a weekly basis or a fortnightly basis, continuous basis पे CLM2 करता हूँ. So that is possible. So I make a master DOA of say 100 crores, and every week I am doing a 20 crores CLM2 transaction. Is that possible?
Well, the lawyers would probably want to answer. And conflict of interest. And मैं कर दूँ मैं disinterested party वाला answer. You rightly mentioned. I think it's perfectly okay. Have a master deed which is a kind of envelope agreement that within a particular range will keep on assigning. As and when you assign, just do an intimation. So you don't need to do a so-called assignment agreement every time. In lots of so-called replenishing transactions also similar structure. Bankers have long been using the same structure for loans against shares. Shares are replaced. They don't do a pledge every time. They have a master pledge agreement under which shares are replaced every time. So this is similar to that. There'll be, the envelope agreement should provide for subsequent transfers within the particular, boundary, within the particular range that you fix. That should serve the purpose.
Thank you so much. And one last question, sorry. So there is lot much clarity available on the CGTMSE guidelines. You can do
I
CLM.
think RBI has come up with one clarification now.
So I'm saying lot much clarity is available with respect to CGTMSE, assignment of pool, or CLM2. But there is not much clarity available with respect to CGFMU. So is it possible to assign pools sourced under CGFMU under CLM2 or DA transactions?
Would any of you would like to take this or? Okay, so my take would be that any loan, whatever be the underlying security or guarantee, once you bring a co-lender, the benefit of the entire security or guarantee goes to the assignee. That's the basic law of assignment, that whatever was the security, guarantee, collateral, benefit, whatever was available to the assigner will pass on to the assignee as well.
So same holds for CGFMU
that
as well.
holds true for any guarantee, be it a loan level guarantee or even a pool level. For example, if let's say the pool is guaranteed by let's say an FLDG, will the benefit go to the co-lender? Answer is yes. The benefit goes to the pool and therefore inures to the co-lender as well.
Thank you so much. That was very helpful.
Thanks. It's been wonderful. Last 1 minute to each one of you. Last 1 minute, because we need to be stopping at next 5 minutes. But Bonani, last 1 minute.
Just a closing remarks, right? Yeah. So I think I agree with Shilpa that ultimately none of us need a regulator if we know what's the right thing to do, and we all know what's the right thing to do when we are doing business, that is taking care of the customer or responsible lending. If we do that, the regulator will be out of his job actually. We do it the right way. Sometimes we do need advice, do need a parent, right? But mostly we know what to do. And to sustain ourselves and to sustain this entire sector, it has to be customer first, compliance first, it has to be responsible lending, it has to be ESG at the core. That's all. Thank you so much.
So my closing remarks would be that keep it simple. Do all the compliance, due diligence, KYC, onboarding of customer norms, and just keep in mind that this is a book that you haven't acquired, treat it like a book that you have created.
I think, one way where the industry can really come together and solve this problem is self-regulation, like you were talking about, and the SRO. And I think the SRO is a very good platform that can actually be leveraged, which will act as a bridge between the regulator and the ecosystem where there is no regulation. And then that kind of gives the industry the ability to drive regulation and the direction of regulation in some sense. So I think it's a very powerful tool that can be leveraged. It has a lot of potential.
Excellent. Ashish ji and Jyoti ji, I hope you're listening. Very important task for you all. Go ahead, Vidushi.
I would say there is nothing to be scared of. I feel that the industry is very scared of generally because of the actions taken by the regulators. But we have to be mindful, like we discussed, if we all want to follow the law by its spirit, we will do the right thing, and there's nothing to be scared of. Co-lending is here and it will strive.
Excellent. So my closing remark would be that in the end, everything is fine. If it's not fine, it's not the end. Thank you very much.
Thank you, sir. So we would like you to stay on the stage for a bit. I would now like to request our moderator to felicitate our panelists, beginning with Miss Bonani Roychoudhury, MD, NABSAMRUDDHI Finance Limited. And now a moment to capture. Sir, the goodie as well. Our next speaker, Miss Geeta Chainani, Associate Director, Care Ratings Limited. Oh. Okay. Apologies for the confusion. Miss Shilpa Mankar, Ahluwalia, partner. Shardul, Amarchand, Maangaldas. Miss Vidushi will take it. Thanks, Smita. And now, Miss Geeta Chainani, Associate Director, Care Ratings Limited. And now, none other than for Kothari sir, I would like to call Mr. Ashish Agarwal sir to felicitate him. Please bring your hands together, everyone. Freezing the moment for session 3, sir, to remember.